Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Yesterday, the Reserve Bank Board left interest rates on hold as expected, but the bank is starting to sound a little more positive about the inflation outlook. We've spoken many times to economist Warren Hogan, who has one of the best track records on predicting rates. He was the only economist to predict a year out that the official cash rate would hit 4.35%. Also, one of the first to say that if there was an interest rate cut coming, it wouldn't happen this year. Warren, you've been proven correct. Warren, of course, is Managing Director of EQ Economics and Economic Advisor at Judo Bank. Welcome back to Fear and Greed.
Thanks for having me on the show, Sean. It's a great pleasure.
What do you make of the Reserve Bank Board meeting yesterday, the statement afterwards, and Michelle Bullock's comments?
Yeah, I think it was a really important and really smart way of playing this from the RBA board. So obviously no rate cut and no consideration of it. We know that. They're not even thinking about it. But after 6 months of hanging a rate hike over the heads of the Australian people and the Australian economy, they have pulled back, and it's for good reason. They are essentially trying to jawbone their way through this inflation problem, i.e. the narrow path, i.e. not taking rates to the sort of levels they might have in the past or what other central banks have done overseas. Jawboning is a critical part of this. But the politics is tricky, not just in terms of Canberra and an upcoming election, but the broader community. You know, they don't like rate hikes. They want to see a rate cut. So with a long summer break coming, and this is the biggest break we've ever seen for the RBA board, we're not getting back together for about 9 or 10 weeks. And with all the sort of political stuff we're going to see over the summer, they just thought, we're going to pull back. You know, we're going to pull the rhetoric back. We're going to park the jawboning. And I think that's really smart, because the reality is that with such a big break, the whole thing could change. It may not, but they will deal with what's the economy doing early in 2025 when they next sit down. And of course, we've got some important stuff coming over the summer, and that is this new interest rate committee that has now been legislated, and of course the appointment of new members by the government. They don't want to poke the bear. They don't want to upset the government any more than they have to. And so I think this is a smart move. But as the governor said in the press conference, this doesn't tell us anything about what's going to happen next.
What will happen next, do you reckon?
I wish I knew.
Michelle Bullock would like you to know too.
Yeah, I bet she would like to know too. That would make for a lot better sleep at night. Look, I mean, I can see how this can play out. You know, we are making progress. The last quarterly CPI, stripping out all the noise and all the stuff from the government, is looking a bit better. But there's a long way to go, and before we can be comfortable. But the economy's soft, so we could be there, and we could start to see rate cuts in the middle of next year. I really don't see one happening in, well, certainly not February. It's something really significant would have to shift. What's worried me the whole time, and what is the basis of a lot of my work, is we've finished the nominal tightening. It's 18 months it takes to work through. We've had one rate hike in the last 18 months. All that 425 basis points of tightening we saw, which all of us thought was going to knock this economy off its perch, we've absorbed it, and it's exiting the system. Now it's all about the real interest rate, the RBA cash rate minus inflation, and that's not very high. It's less than 1%. The RBA cash rate's not much higher than core inflation, and history shows it probably needs to be higher. People will argue it doesn't, and there's all these different views on it. My view, given that I think the world's changed since the pandemic, demographics, a whole bunch of stuff, what scares me, what I think is going to be the basic question is a 1% real interest rate going to get inflation down and keep it there? And I just don't think it will. I hope I'm wrong. We just don't know. So we just got to see. If we start to see the consumer business spend more as we head into 25, it's not great news. We really do need to keep demand in the economy soft for a little bit longer to ensure inflation gets all the way down. So we just wait and see. I fear that the opportunity to take out some insurance this year against an economy that takes off again, it was missed, and the political environment made it very hard for them to take out that insurance. It was very costly insurance. And I just hope for all of our sakes that we don't see an economy that really starts to pick up pace through 2025 and inflation later next year starts to pick up again, because then we could be looking at lots of rate hikes in a recession. And I just hope that doesn't happen. It's not the core view, but it's a risk.
On that basis, if you're talking about real interest rates need to be higher than 1%, even if we get inflation to 3%, let's say, 1% plus, you're still at 4.35% anyway. Is it the fact that, since the GFC, we've had ultra low interest rates? Is this our new normal though? Should we should we stop talking about the need to cut rates plenty of times and say, yeah, maybe we do need to cut it once or twice, but this is life going forward?
Yeah, and Sean, that's the point. And that's what I've been trying to get across to the community or the people I speak to in business is that, whether we cut rates or not or whatever, this is the new normal. It was an unusual period between the GFC and COVID. We're not in that world anymore. And the cash rate's probably going to average somewhere between 3.5 and 4.5 for the next 10 years. So in the current environment, given the narrow path, not only is it not clear that they actually can cut rates at all, but if they do, it's probably only one or two times. And that's actually increasingly becoming the view of economists and forecasters that you see in the surveys. So I think that's a really important point. And it speaks to the biggest issue that is sitting here for monetary policy, and that is where we came from. The real stress out there, and the thing that's really an issue, is that a lot of people took on really big mortgages, smart people, doctors, lawyers, bankers.
Podcasters, Warren,
Podcasters, yes.
And you're talking my story here. Go on.
Well, we did it when rates were really low, and we did it with a bit of comfort from what the governor said back then about keeping them low for a while. And the fact is, the question is, should we have taken rates that low? And of course, the massive move up in rates, the nominal tightening, is what's shifted the game for so many people. And we want to go back to where we were, but we just aren't. And if you can't finance a mortgage at this rate, then you've got to seriously look at it, because I don't think you're going to, in any structural longer term sense, get a much lower mortgage rate. And there is still a risk that they could have to go higher. Maybe not in the short term, but in 26 or 27, who knows if the cash rate has to go to 5.5%. It did in the United States. It did in New Zealand. And that's another percentage point. And that really is a significant further shift for many people.
Stay with me. We'll be back in a minute. I'm talking to Warren Hogan, Managing Director of EQ Economics and Economic Advisor at Judo Bank. What about the economic cycle? You mentioned that earlier on. Well, two things I want to talk about: the economic cycle and the changes to the Reserve Bank that are coming next year. The bank has always, since, Ian Macfarlane, Phil Lowe, they've always spoken about, if they don't cut rates, or they do cut rates in an economic cycle, that's being political if they're not just following their judgment. Do you think that's the case?
Yeah, look, I've always thought, particularly when it comes to an election campaign, that's not the right way. The government goes into caretaker mode. The RBA should. I was there when Glenn Stevens hiked in the 2007 election campaign, and I'd been saying for a long time, myself, Saul Estlake, who I worked with, that they should be going. Now, they could have gone earlier. The fact that they didn't go and they left it to that point was their fault. But if they waited another month until after the election, was that going to change anything? They're the ones who probably should have done it earlier and left themselves in that position. So I've had a strong view that once you get into a campaign, there shouldn't be any. But in the moment, we're talking about political pressure, about movements in rates, and not just a hike, but also the need for a cut 6 months out. So I think this is the problem. The politicisation of monetary policy started with Howard in the 96 election with the debt buses and all that stuff. That coalition government utilised the sort of the fear of debt. And then, of course, that's when mortgage debt really took off in this country. There were changes in banking. And it's just got worse and worse. And it's now at this, I hope, crescendo peak, because, there's people who frame this election as being rate cut, you'll win, rate hike, you'll lose, no change, minority government. It's not that simple. But it's getting dangerous. It's getting dangerous for our politics, and it's getting dangerous for the RBA. And I think it's not a good development at all. Okay,
what about the new interest rate setting board? Do you think that will make much of a difference next year?
No, I don't. The muscle behind monetary policy remains the RBA. And for all the criticisms, justified or otherwise, this is an institution that contains some of the most dedicated, smartest people in our nation, and economists definitely. And that's the muscle. Is the Treasurer, like the market is sort of saying, oh, well, we've passed the legislation with the help of the Greens, they're going to stack the board and cut rates in April. The Treasurer is not going to do that. And the RBA board isn't going to do that. The kind of people they put on, people have opinions, but look, you come in as an individual, and no matter how smart you are or what information you got, and try and carry the day across a board and that muscle that is the RBA, that's not the right view, it's not going to work. So I don't think our monetary policy is going to change, and I don't think the Treasurer is going to do anything silly with the appointments.
Okay, last line then, Warren. This time 12 months. What are interest rates going to be like?
I actually think the safest bet is 4.35.
Right.
I think there's a slightly bigger chance that they'll be higher than materially lower, but it's marginal. And so I'm going to completely cop out and say they're going to be exactly where they are. And that could well be some record for how long rates have stayed where they are.
Yeah, I don't think that's a cop out, because most people will come and say no, they'll be lower. So I think that's actually going out on a bit of a branch on that one.
Yeah, well, there may be some cuts. That is the easy view to have. I just don't think monetary policy is restrictive anymore, and I don't think this level of interest rates is extraordinary. I think it's the new norm.
Yep. Warren, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Warren Hogan, Managing Director of EQ Economics and Economic Advisor at Judo Bank. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.